The Dow Jones Industrial Average closed above 53,000 for the first time in history today. The S&P 500 gained 0.72%. The Nasdaq Composite jumped 1.12%. And the leadership came from the exact same semiconductor stocks that got crushed before the holiday break. The VanEck Semiconductor ETF rallied 2.4%. Intel gained more than 3% on a CPU price hike announcement. Marvell Technology and Teradyne each bounced more than 4% after being among the hardest hit names in last week's chip rout. Broadcom added 1.2% on news of an extended custom chip partnership with Apple through 2031. The session was a mirror image of last Thursday. The Dow's record-setting strength on July 2nd came as the Nasdaq sold off and semiconductors got hit. Today, the Nasdaq led and the Dow's advance was more modest. The same capital that rotated out of growth and into cyclicals before the holiday rotated right back over the long weekend. Welcome to Market Lens. I am Daniel Reed. Today is July 6th, 2026, the first trading day after the Independence Day break. And the market is sending a clear message. The rotation is not a trend. It is a whipsaw. Let me start with the numbers that framed this session. The Dow Jones Industrial Average closed up 132.48 points, or 0.25%, after touching a new all-time intraday high of 53,092. This is the first close above 53,000 in the index's history. It follows a 594-point surge on July 2nd that took the Dow to a record 52,900 before the holiday. In two trading sessions straddling a four-day weekend, the Dow has gained roughly 725 points. The S&P 500 ended at approximately 7,537, up 0.72% from the July 2nd close of 7,483. The Nasdaq Composite climbed 1.12% to approximately 26,122. The Nasdaq 100 rose approximately 1%. The VIX settled at 15.81, low by historical standards, and down from the 19.50 panic spike during the June 23 semiconductor crash. The catalyst that flipped the tape was not a single headline. It was a stack of supply chain signals that came together over the holiday weekend. Foxconn, also known as Han High Precision Industry and the primary assembly partner for NVIDIA's AI servers, reported second-quarter revenue of approximately $47.5 billion over the weekend. That figure exceeded analyst expectations and confirmed that demand for AI infrastructure is not slowing. Foxconn's sales are a leading indicator for NVIDIA's data center revenue, and the beat renewed confidence that the AI build-out is still accelerating. Broadcom announced it expanded its agreement with Apple to develop and supply custom chips through 2031. This extends a relationship that already generates roughly $15 to $20 billion in annual revenue for Broadcom and cements its position in the custom silicon market. The stock gained 1.2% on the news, a modest move that tells you this was priced in at the partnership level, but matters for the long-term visibility of Broadcom's semiconductor segment. Samsung Electronics reports preliminary second-quarter earnings tomorrow. Analysts expect an 18-fold increase in operating profit compared to the same quarter last year. That is not a typo, 18 times. The company's share price has already rallied 165% this year. Expectations are extraordinarily high, and the risk is that even a blowout number is already in the price. The market will focus on memory pricing guidance and CapEx plans for the second half. Samsung Electronics reports preliminary second-quarter earnings tomorrow. Analysts expect an 18-fold increase in operating profit compared to the same quarter last year. That is not a typo, 18 times. The company's share price has already rallied 165% this year. Expectations are extraordinarily high, and the risk is that even a blowout number is already in the price. The market will focus on memory pricing guidance and CapEx plans for the second half. Now let me layer in the macro picture because today also brought new data on the U.S. services economy. The Institute for Supply Management reported that its services PMI came in at 54.2 for June, down from 54.8 in May. That is a modest decline and still firmly in expansion territory. The details under the surface are what matter for the forward outlook. The Business Activity Index dipped to 54.6 from 56.2. New orders slipped to 53.8 from 54.8. But the employment component rebounded to 52.0 from 48.1 in May, ending 3 consecutive months of contraction in services sector hiring. That is the most important number in this report. After the June non-farm payrolls miss showed only 57,000 jobs added, the ISM services employment bounce is a signal that the labor market weakness may be concentrated in goods-producing industries rather than the broader economy. The prices paid index fell to 58.2 from 61.4, a 3.2-point decline that continues the trend of decelerating input costs. Lower oil prices are flowing through. WTI crude settled at $68.69 a barrel today. Brent crude held near 72.10. OPEC Plus approved another production quota increase of 188,000 barrels per day starting in August, and shipping traffic through the Strait of Hormuz is recovering. The UK Maritime Trade Operations reported that 160 vessels, including 98 tankers, transited the strait between June 29th and July 4th. That is below the pre-war daily average of roughly 138, but the direction is clearly improving. The oil story matters for the rate narrative. Lower energy prices reduce headline inflation pressure, which gives the Fed room to hold. Combined with the soft payrolls print last week, the case for a September rate hike is weakening. CME FedWatch data now shows the implied probability of a July hike at 24%, down from roughly 30% a week ago. September hike odds have fallen to approximately 50% from 64% before the NFP report. The 10-year Treasury yield drifted lower to 4.47%, down from 4.50% last week. The dollar index was flat at 100.86. Gold eased 0.29% to $4,163 an ounce after rallying 2% last week on the NFP miss. Now let me address the two developments that will shape the rest of the week. First, the Federal Reserve releases the minutes from the June FOMC meeting on Wednesday. This is the first set of minutes from Chair Kevin Warsh's tenure. The July 2nd payrolls report happened after this meeting, so the minutes will reflect the pre-NFP discussion. But the market will scrutinize every word for signals about how the new chair is steering internal debate. Warsh has emphasized that he wants less forward guidance and more real-time data dependency. The minutes will be the first window into whether the committee is aligned with that approach or divided. Fed Governor Christopher Waller defended forward guidance in remarks today, calling it a valuable tool under the right circumstances. That subtle pushback against Warsh's communication philosophy is worth watching. The new chair and the sitting governors may not agree on how much the Fed should tell the market about its intentions. Second, the second quarter earnings season begins to pick up this week. Delta Airlines reports on Friday. PepsiCo also reports this week. S&P 500 companies are expected to post year-over-year earnings growth of approximately 24.4% for the quarter, according to LSEG data. Semiconductors and energy are expected to account for roughly half of that growth. The earnings bar is high, and the guidance commentary around AI CapEx, consumer demand, and input costs will determine whether the market can sustain current valuations. Let me tie this together. Today was a snapback session. The semiconductor stocks that got sold on July 2nd bounced as supply chain data and corporate announcements reaffirmed that the AI demand cycle is intact. The Dow crossed 53,000 for the first time, but the real momentum was in growth names that had been out of favor for exactly one trading session. The rotation trade between value and growth is happening at high frequency. Capital is not leaving the market. It is moving between sectors on a session-by-session basis. The ISM services data confirmed that the services economy is still expanding and that employment in the sector is recovering, even as manufacturing remains under pressure. Oil is giving the Fed breathing room. Rate hike expectations are declining. The macro setup is favorable for risk assets entering earnings season. The risk is that expectations are already high. The S&P 500 is roughly 1% below its all-time high of 7,621 set on June 2nd. The Dow is setting record after record. Semiconductor stocks have already priced a perfect earnings outcome from Samsung, SK Hynix, and the US chipmakers reporting this month. If guidance disappoints, the whipsaw will snap back again. The S&P 500 has support at 7,350, the level that held during the June 23rd semiconductor crash. Resistance is at 7,550, a level we tested today and could break this week with the right catalyst. The Dow has new support at 52,900, the previous record, and resistance at 53,100, today's intraday high. The Nasdaq has support at 25,800 and resistance at 26,400. The market is back to within striking distance of all-time highs after a holiday-shortened week and a payrolls miss that reshaped the rate narrative. The question from here is whether the AI trade has the fundamental backing to sustain a return to those highs. The signals from Foxconn, Broadcom, and SK Hynix say yes. The Samsung print tomorrow will be the first real test. I am Daniel Reed. Keep your data sharp and your logic sharper.